Kevin Warsh was handpicked by President Trump, and now the whole market is watching. Welcome back to Investing Mom Life, where I talk about investing, stocks, real estate, macroeconomics, and everything that affects American families. And this Fed story matters because this is not a normal regime change. Warsh appeared in front of the Senate, and the biggest question was, will he keep the Federal Reserve independent? Will he follow political pressure to cut interest rates? Warsh said he would keep the Fed independent. And yes, that matters because President Trump wants lower rates. Markets want rate cuts. Homeowners want cheaper mortgages. Businesses want cheaper loans. But bond market may not agree. Because right now, Fed is not walking into a calm economy. We have rising bond yields. The oil prices are under pressure because of the Middle Eastern conflict and Iran war. We have inflation concerns that are still not fully gone. We have high mortgage rates that are still very painful for American families. And we have the government who is already paying higher interest rate on the national debt. Reuters reported that Treasury Secretary Scott Bessent said that the current surge in bond yields and energy prices is being driven by the Iran war and inflation concerns, although he argued those pressures may be temporary. So the biggest question is, can Kevin Warsh actually cut rates quickly? Or the bond market will force the Fed to keep the interest rates higher for longer? Because the Fed controls short-term rates, but the bond market controls the long-term rates, and that affects the mortgage rates. And if the investors believe inflation, deficits, oil prices, or political pressure are getting worse, they can demand higher yields no matter what Fed wants. So today, let's break down Kevin Warsh's Fed reset, why Wall Street is watching so closely, and what this means for stocks, housing, debt, savings, and your money journey. To understand why this matters, we have to know what Federal Reserve does. The Federal Reserve has a massive influence on economy. It controls short-term interest rates. It manages money supply as well as liquidity conditions. It oversees a massive balance sheet. It communicates with markets. It is supposed to provide price stability as well as maximum employment. For years, investors got used to Jerome Powell's Fed. Powell's Fed was very communication heavy. Investors watched every Fed meeting. Markets got trained to ask, when is the Fed going to cut rates? When is the Fed going to pause? When is the Fed going to rescue markets? But Kevin Warsh appears to have a different philosophy. He has criticized Fed's large balance sheet, too much forward guidance, and he believes that Fed needs to regain its credibility. And that is why people are calling it a possible Fed reset or a regime change. Investors are going to see what is going to happen. Will the markets be rescued by Kevin Warsh? Time will tell. Now let's talk about the most important issue, the Fed's independence. Federal Reserve is supposed to make decisions based on the economy, not by the political pressure. That does not mean Fed is perfect. Fed has made mistakes before. Many people believe the Fed kept rates too low for too long after COVID. Many believes that Fed was late to respond inflation in 2021 and 2022. So the accountability matters, but independence also matters. Because if the investors start to believe that Fed is under political pressure, they would start to question if the Fed is going to fight inflation. And if they start to question Fed's inflation credibility, they can demand higher yields on the Treasury bonds. That is exactly why Warsh's Senate testimony matters so much. He said he's going to keep the Fed independent. That's reassuring. But the market is still going to watch what he actually does. President Trump wants rate cuts. And if Kevin Warsh cuts rates too quickly, while the oil prices are under pressure and inflation risk is still there, we are going to see that pressure in the bond market. Bond market might see that political pressure that could backfire. Instead of getting lower long-term rates, we could get higher long-term yields. Reuters reported that global central banks are already watching Warsh's view on Fed's independence. especially because his comments about the Fed crisis fighting role unsettles some of the central banking peers. The question is not just will Warsh cut rates, but the bigger question is, will the bond market believe him? So the Fed is in a very difficult position. So now let's talk about the bond market. Every investor needs to understand this. Fed controls short-term interest rates, while bond market controls long-term interest rates. So Fed can cut federal fund rates, but it cannot force investors to buy bonds at lower yields. The 10-year Treasury yields is especially important because it affects mortgage rates, business loans, stock valuations, and financial conditions. If the investors feel confident that inflation is under control, they may accept lower yields. Now, let's talk about Fed's balance sheet. Fed's balance sheet is basically the pile of assets that Federal Reserve owns. Mostly those are Treasury bonds and mortgage-backed securities. So during the great financial crisis, as well as during the COVID time, Fed bought a lot of bonds to support the economy. This helped keep the markets functioning. It helped push the borrowing cost lower. It did help add liquidity into the system. So there was a downside. When money becomes cheap for long term, the asset prices rise dramatically. Stock prices go up, real estate goes up, risky assets go up like Bitcoin, Ethereum, and the speculation increases. That is why some people argue that Fed's massive balance sheet created the asset inflation. Warsh has criticized Fed's large balance sheet and has also suggested that Fed should reduce its footprint in the financial market. In simple terms, he does not want Fed to be a giant buyer in the markets. Now, here's the big risk. If the Fed reduces its presence aggressively and stops buying bonds, that means less Fed demand for bonds. And less demand for bonds can lower the bond prices. And when the bond prices fall, the yields rise. Higher yields means higher mortgage rates, higher business borrowing cost, more pressure on stocks, and the government pays higher interest rates on the debt. So shrinking the balance sheet sounds responsible, but done too aggressively creates a lot of stress, creates a lot of chaos. What do you think? Kevin Warsh would cut rates quickly, or the bond markets will force the Fed to keep the interest rates high? Thank you for watching my videos. Please subscribe my channel if you like watching my videos.